Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. I am bringing you perhaps one of the most important videos of the year. This is a topic. This is something we all need to think about as one rental at a time fans, followers. We are going to be talking about something that the rich, the uber rich use today. In order to do that, we are going to talk with Omar and David. Omar, how you doing this morning?
Very good, Michael. How are you? What's going on, David?
Hey,
Dave,
how are you guys?
doing
Happy
great.
to be here.
Awesome, David. So you are going to be the rock star of this first video, but let's set it up. So folks that follow One Rental at a Time know that Omar is a Tuesday expert. He's my real estate entrepreneur. Let's just say on Sunday, I get a phone call from Omar, which is awesome. I love it. I love our conversations. I happen to be in the middle of a 6-mile run, so I didn't pick it up. That's what I was doing. Then Omar texts me and goes, Zuber, stop what you're doing. Listen to your voicemail. I'm like, dude, I hope he's okay. I mean, okay, I'll stop. I call it. And he basically goes, I got a guy that's going to save us a ton of money. He used slightly more colorful language than that. I'll keep it PG for this conversation. And sure enough, he has brought us David. What David and I are all three of us are going to talk about today is depreciation. We're going to start there. Then we're going to talk about cost segregation. And finally, we're going to talk about David bringing it to the everyman. Omar and David, does that sound like a plan?
Sounds like a plan. Let's go.
Yeah. So I guess let's first talk with depreciation. If you're One Rental at a Time fan, you probably know it's a non-cash expense. You know that it is a charge that you can take basically as the IRS gives us the ability to use it to essentially hide income, or I don't know if hide's the right word, but yeah, hide income. David, what would you say about depreciation? Talking kind of to the everyman or every person out there.
Well, everything wears out over time.
Yep.
Except for maybe land, but anything in a building it wears out over time. So the IRS gives us the ability to write off a certain portion of that kind of depreciation as it loses value over time. And most often for residential rentals, it's 27 and a half years.
Right.
The easy way to do it is just take 127 and a half of the cost basis of the property minus the land, because land's not depreciable.
Right.
And then take that as a deduction off of your taxes every year. So as things wear out, you're allowed to depreciate them in value over your taxes.
And it's 100% legal.
Oh, yeah. I mean, it is expected practice, common expected practice.
Absolutely. And yeah. And Omar, this is important for you and I, because again, we're residential guys mostly. You and I have been talking off air as friends. It's like, we need to buy a lot more property. I have told you personally, I ain't selling squat next year, right? I want to buy more. And you and I were thinking like, okay, just generally speaking, if we were going to buy, $1 million in real estate, we'll ignore land and we'll just make this easy conversations and we'll call it 30 years versus 20 and a half. It's like, hey, $1 million allows us to save about $33,000, right? That's roughly speaking what we were talking about. And you and I were looking at each other going, we got to buy a lot of property.
Right? We really do.
To get to that number, right? And this is why David is here, because there is this other thing that for decades have been used by the big boys, right? And I'm talking Grant Cardone big boys, right? And it's this thing called cost segregation. So David, talk about what cost segregation is, again, simply speaking, and then we'll break it down why it's so important today.
Well, typically the way we look at a building is as a whole.
Correct.
It's the easy way to do it. It's, the standard way everybody does it. And I'm dating myself, but I don't know if you guys are old enough to remember the commercial for the Big Mac. So either you look at a Big Mac or you look at 2 all beef patties, special sauce, lettuce, cheese, pickles, onions on a sesame seed bun, right?
Exactly.
Oh, that's good.
So
yeah.
Cost segregation is actually us coming in. The company that I work with is Cost Segregation Services, Inc. We come in, we do an engineering study of the property, and we break it into all its component pieces and parts. Well, all of the non-structural parts in that building are assigned actually a shorter depreciation life by the IRS, only you have to know what they are.
Right.
So some of the stuff can be depreciated at 5 years, some at 7 years, some at 15 years. So what a cost segregation study does is it segregates all of those items into their actual depreciable life, which then accelerates your depreciation. Thanks to the Tax Cuts and Jobs Act back in 2017, we have now until the end of next year, 100% bonus depreciation.
Woo!
So what that means is everything that's 5-year life, 7-year life, 15-year life can be deducted 100% the first year.
Oh, wow. Perfect.
So we're accelerating your depreciation by a huge amount. Now, a lot of times people will say to me, yeah, but over the 27 and a half years, it's all going to wash out anyway, right? It would, unless you understand the time value of money.
Exactly.
If I was going to give you $1 million, I could either give it to you all at once, or I could give it to you over the next 27 and a half years. When would you rather have it?
Right now.
Right now, of course, because you can put that to work either paying off debt, buying new property, going on vacation, whatever you want to do, you can put it to work and you can make a ton more money than we're even able to save you through the deductions by having it now and being able to put it to work. So cost segregation in a nutshell is accelerating that depreciation so that you can take it all in the front end. I hear people all the time, and I did a video on the myths about cost segregation. Well, one of the myths is, oh no, this is going to trigger an audit. The IRS actually calls engineering-based, there are 6 different methods in the tax codes for doing a cost segregation study. There is one that the IRS calls the certain method of depreciation. That is an engineering-based, cost segregation study, which is the kind of study that we provide. It's not easy to do, takes a little bit of work, but well worth it.
Yeah. So again, I've been in this game a long time. I have an accounting background. This is, and let's be very clear, one of the reasons that syndication in large apartment buildings has taken off recently is because of bonus depreciation, a la cost segregation. You hear all of these big players, and you all know who they are, talking about making all this money and not paying any taxes. It is because they are doing large deals and taking gargantuan, cost segregation and bonus depreciation. Think about that. 5, 7, and 10?
5, 7, and 15.
Oh, 5, 7, and 15. Thank you.
Jeez.
All of those things that you could have depreciated for 5, 7, or 10, all right now. So most people watching this, David, have no idea. So I'm going to ask to do rule of thumb estimates. And if you're not comfortable, it's okay. I'll guess for you. But let's just let's just take a big apartment building, assume it's 100 units, and easiest math possible, it's $100 million. We'll ignore land for now and all those other things. Right. You could do it the old way. And again, in an apartment building, it's not 27 and a half. I think it's 33 years. Is that right?
No, well, commercial property, any rental residential property is 27 and a half.
Right. Commercial
property is 39.
Oh, 39. Okay. So again, right, I said 100 unit apartment, so it would be 39 in this case. But anyways, same idea. It's $100 million house. And when you're doing an engineering study on a house or a residential property, and you go in and you look at it and say windows and flooring and this and that, are we talking roughly 10%, roughly 15, roughly 20%? How much of that $100 million, and if you want to make it 100 grand, fine, but how much of that complete widget, right, the Big Mac versus whatever it was, buns, meat, dressing, pickles,
double patty,
whatever it was, the pieces, what
I
percentage of that could be depreciated faster than either 27 and a half or 39?
Generally, we look at between 20 and 40% of it.
That's what I would have guessed.
Wow.
Yeah, and sometimes even more. It kind of depends on the property and
the
that
study,
sort of thing.
right? That's why everyone is individual.
Depends on the study. Yeah, absolutely.
Yeah. So let's just be conservative. Let's say it's 25%. And this is why it's a big deal for Omar. This is why Omar calls me on Sundays. This is why Omar sends me a text. Let's just say Omar buys $4 million in residential property next year. Again, ignore land. It's 10 properties at $400K each, right? So he's looking at in his case, 27 and a half years. So let's just do the math. I like math. So take 4 million bucks, Omar, divided by 27 and a half. What do you get?
That would be divided by 27 and a half equals 145,454,000.
So that's not bad, right? So Omar and I have conversations. We're going to buy a lot of real estate. We're not going to sell anything. Omar would be able to take a depreciation fully supported by the IRS of, let's just call it 150K for easy math.
Okay.
All right. Kind of cool. Now let's go in and do 4 million bucks in times 25%. It's again is between
$1 million.
Yeah. Do that one in your head, right? So which would you rather have? $150,000 savings next year, Omar, or $1 million in legal tax deductions? I'm just asking.
$1 million, because you can carry it over for like the next 3 years.
Well, you're going to get it all year one. You're going to get it all. It's a year.
Well, if it causes a loss,
right,
it carries over.
you can carry it forward as long as you need to eat up that loss.
Yeah, but he's a big hitter, David. That $1 million is
I know we're about to save Omar a whole lot of money.
Yeah. And again, folks, this is 100% legal. It is something
it's actually recommended by the IRS.
Recommended. Oh yeah, it's absolutely recommended. And we got one more year. We've got 14 months left to take advantage of this. Go ahead, Omar.
So let me ask a question here, David. When you say 100% bonus, right? And that's this bonus that we are good through the end of next year, right? But let's just say after next year, where does it go to then?
I'm not sure the exact percentages. Before the Tax Cuts and Jobs Act, we were at 50% bonus.
Oh,
and
okay.
So properties that were purchased before the Tax Cuts and Jobs Act would be subject to that 50% bonus.
Right.
Once we hit the end of 2022, 100 goes away. And then over the period of a few years, they're going to take it down to 0. So I'm not sure. I have the chart, but it goes down 20% a year or even more. The other thing is, and you know this, we don't know what's going to happen with the tax code.
Exactly. Take it now.
Take it now, because if you don't, it may be a use it or lose it kind of thing.
Yeah.
Now, let me tell you a couple of other wrinkles to this that even Omar and I haven't talked about.
Okay.
You buy a piece of property and you renovate it. Okay. The renovations can be included.
Absolutely.
You own a piece of property for over a year and you renovate it, then you can actually take a deduction for everything you tore out, drywall, everything that we call it cash in the trash. Everything that you tear out, it's a partial asset disposition. Nice. And can mean a whole lot of stuff.
Yeah.
You have to be careful though, because in doing a cost segregation study, you have to be very careful that you follow all the recommended rules and those kinds of things. As to, and I teach CPA classes on this. In the future, they have to make different choices now as to what they expense and what they capitalize. It's based on the 2014 repair regulations. We actually look at every item and create a building system valuation to help their CPA make decisions in the future.
Nice.
Wow.
For any property that's owned from before this tax year, the CPA, when they file the next taxes, are going to have to file a form that, from what I understand, I'm not a CPA, I know a lot of them, but from what I understand is a pain to fill out. It's called a Form 3115 or a change of accounting principles. Because we know that that's such a pain for the CPAs to fill out, we do it for them at no charge to them. And so I've had some CPAs that once I told them that, they said, oh, done.
Let's go.
Yeah, let's go. As long as you're going to fill out those forms and all we have to do is sign them, we're good to go.
Yeah.
Well, question for you, Bob. And you know what? This is something, David, anything that I have purchased that I've owned since 2000, let's say 9, 10, 11, 12, 13, 14, 15, 16, all the way up to 2017 with the tax cuts. All of those properties before 2017, I can get a 50%, 100% bonus depreciation on, right?
They are subject to whatever the bonus depreciation rules were in the year that you purchased
Got it.
them.
Year of acquisition.
So, but
Okay.
anything since the end of September of 2017 up through the end of next year is 100% bonus depreciation.
Yeah, this is
Wow.
all, Omar, what I would tell you to think about this is basically what you're buying next year. You're going to, knowing, again, I know what you're planning to do. I know what everything else you have going on. You buy about $4 to $5 million in real estate next year. You're going to be good to go. You're
Well,
gonna-
yeah, then okay.
You're going to end up with this big old number at the bottom.
Oh, a lot more in the bank. That's going to be even better.
There you go.
That's a good thing generally, I think,
Yeah,
from what I
generally,
understand.
yeah, generally a 0 at the bottom of a tax statement is pretty good.
I work with a lot of really happy real estate
I
investors
bet.
and commercial business owners, you know.
Yeah, I bet. So David, let's just get to the point. This is not free. You do not do this out of the kindness of your heart. There's probably some level you're like, hey, if you're buying a 50K house, don't bother. It's not worth it. I don't know where that is, but is there kind of a level where you're like, hey,
There is.
yeah,
Typically, it used to be that only the cost segregation companies in the country would only consider buildings over $1 million.
yeah, I know.
Individual buildings over $1 million.
Because it's real work. It's a real study. Yeah.
When CSSI was founded, and it was founded by, let me go back. You know, and you mentioned that the cost segregation used to be cost prohibitive.
Yep.
Mhm.
Back in 1997, and very few people knew about it. The Fortune 100 knew about it, and that was about it.
Mhm.
But back in 1997, the IRS was after Hospital Corporation of America for millions in back taxes. Hospital Corporation of America said, we don't owe this because of this provision in the tax code called cost segregation. Well, the IRS wouldn't leave them alone, as the IRS is known to do, you know. So they hired an engineer. They did a full cost segregation study, and they won in court, and all of their back taxes were mitigated. As soon as that happened, Walgreens did the same thing
I bet.
and won. That engineer founded the company that I work with to do cost segregation services, Inc.
So
or
awesome.
CSSI. His goal was to make cost segregation available to smaller and medium-sized businesses and investors. And so our rule of thumb is anything worth over about $150,000, including renovations,
Mhm.
is worth at least taking a look at to see if it's worth doing a cost segregation study. I do a lot of those smaller properties. It's surprisingly affordable for something like that.
Mhm.
But, you know, and I can do a free analysis of any property within generally a few days and tell you exactly what the study is going to cost
Mhm.
and approximately what your tax savings is going to be. They always shoot conservatively. So the price is the price. When we show you the price, that's what it is.
Mhm.
But I've seen cost segregation studies that came out 10, 20, 30, even 100% higher in tax savings than the estimate showed. That always makes for another happy investor.
Oh,
Yeah.
I can't wait.
But, and so I work mostly with smaller, you know, guy who owns one rental property or an
Mhm.
Airbnb, or
Mhm.
I have some that have large portfolios as well. But I like working with the little guys because they've never been able to have this before. And,
Yeah.
you know, you're right. I don't do this out of the kindness of my heart, but it does my heart good to be able to help these guys.
Yeah.
I have been nicknamed for the last 10 years or so, Mr. Cash Flow.
Ah.
I have a company of my own called Cash Flow Strategies, and we work with small and medium-sized businesses on improving their cash flow. But it does my heart good to see somebody who actually can make their cash flow really work for them and not have to sweat it every day.
Yeah, it's amazing. I don't know if you can say, but I'm going to ask anyway. So what's kind of the minimum cost of this? Are we talking a couple of grand, 10 grand, 20 grand?
I've seen a few that were under $3.
Okay.
Usually they're close to $3, but the
Okay.
tax savings is crazy. And the
Yeah, of
return
course.
on investment is through the roof anyway,
Right.
for a
No.
small one or a large one. I was telling Omar the other day, I did one, a guy in town here who owns some furniture stores built a warehouse
Mhm.
And his CPA called me and said, it's just a warehouse. I don't know if we could really get much out of it, but would you do a free analysis for him? The study wound up costing him $15,000. It was a $9 million warehouse. Study cost him $15,000. We got him an additional $2.3 million in deductions for that year.
That's
Oh,
insane. My God.
That's called ROI.
yeah, I think I would do that.
He did not hesitate at all.
Yeah, I think I'd pay 15 grand. Because
He
again,
said, go,
folks,
go, go, go.
yeah. So just so you know what that means, folks. So again, he's going to take a legal tax deduction of $2.3 million, which means if he made $2.3 million that year, he will pay 0 in IRS taxes. And again, let's say he made $1 million. He'll carry forward 1.3 to the next year.
And then the
Also-
next year after that.
Yeah.
Until it's gone. Yeah.
We have done over 27,000 studies in all 50 states,
There you go.
and not one time have we ever triggered an audit. And in the few times that the person was being audited for something else and they called the study into question,
Mhm.
we defend the study at no extra charge. And if we have to fly an engineer out to your location for an audit, we'll do it.
There you go.
Beautiful.
Well, David, I think your phone or email is going to ring. How do you want people to reach out to you? Because I have a lot of real estate investors following this channel.
Yep.
So how do you want them to do that? Because it's about to get busy.
They can call me at 770-224-8504, or they can email me at david.wiener, and it's WIENER at costsegregationservices.com. I'll be happy to get back to them with all of my contact information. And all I need is about 4 or 5 pieces of information, and I can run that free analysis for them. Why not check? I mean, it's
Yeah.
worth at least taking a look at.
Oh, easy.
When you don't risk an audit,
Mhm.
and you get all this tax benefit, and I'll work directly with their tax professional as well to make sure that it gets applied correctly.
Very cool. And David, just so I know, that phone number you gave, can they text that, or is that a work phone?
No, that is my
That's fine.
my work phone. It rings to my cell. If you want to text, it's 770-367-8091.
All right, folks, one more time, David, give that text number, because I think that's what most people are going to do is say, hey, I saw you on One Rental at a Time. They might say ORAAT, which is the acronym for One Rental at a Time, ORAT, and they'd like to talk with you. What is the number they can text?
770-367-8091. And please give me your name when you do that,
Yes,
because I
please.
get a lot of texts.
There you go. Well, David, thank you very much for doing this. Your phone is about to blow up. Take care. And Omar, thank you for bringing this to the channel, man. I really appreciate it.
Absolutely. David, we'll be talking soon.
As soon as I get your estimate back, we're going to have a party.
There you go.
That's right.